going to present this afternoon is a sort of a discussion of a subset of a very broad area in accounting, which is environmental accounting. My interest in this stems from the idea, or from the discipline of voluntary disclosure. Financial reporting is about providing information. I am interested in why and how and all the W's that are associated with making disclosures that are not compulsory. If nobody's going to make you do it, why are you still doing it? And what are the pressures that are making you do it? So it sort of seemed natural in the sense that one of the more contested of areas in voluntary reporting within the accounting discipline is environmental reports. And my intention this afternoon is to unpack basically the area roughly, because I understand that this is quite a multidisciplinary audience. So, and then sort of very briefly look at what we already know, what we don't know effectively, and then present a brief research agenda, as it were, of the area. My intention is to engage with you from a multidisciplinary perspective with regards to this, with a view to perhaps pursuing research and collaborative work in the area of corporate environmental reporting. So that's my preamble. I'm just going to check if this works. Okay, my slide thingy doesn't work, but the keyboard tends to do. Okay, this is sort of a model that I like to show a lot of my students when I'm teaching on courses where students don't really have a particular background in accounting. This is a very simplified model of financial reporting, or the financial reporting function. Some of you may have seen this before. So in this model, we've got two key players. We've got the agent and the principal. And you can define that as widely or as narrowly as you wish, depending on where you stand on this. But generally, we take the assumption that the principal is a guy that, or the party that provides the capital. The agent is a party that manages the capital on behalf of the principal. So this principal could be investors, could be governments, so on and so forth. I won't go into great depth on that. So in order for the principal to basically make sure that he knows what the agent is doing, there needs to be a function that allows for reporting. And that's where you've got this function here. The agent supplies information to the principal, and the principal then makes decisions about what to tell the agent, whether to fire him, to reward him, so on and so forth, and the loop carries on. So what I'm really interested in is this part here, which is what I tend to describe as the financial reporting function in this model. So in that respect, the agent basically provides information, and this information can generally be statutory, in a sense that these are statements, okay, financial statements that are required by law for companies to produce. And these include your balance sheets, your income statements, your cash flow statements, so on and so forth. And they're interesting in their own right, but not my particular area of interest. My particular area of interest is I must say that these statutory financial statements are often governed by standards. And these standards are developed by accounting bodies, and at the state of play in 2012 is that for a large part of Europe and other parts of the world, these standards are, they all follow the same standard issued by the International Accounting Standards Board. So there's about 41 odd different standards which people use to prepare accounting information. So anyway, as I was saying, my interest lies in this, which is the voluntary information that firms provide, or the voluntary information that the agents provide to the principal. Because these voluntary information isn't governed strictly by any standards.
I just want to know if you'll be taking questions as we go along, or if you want to wait until the end.
I'd be happy to take clarification questions as we go along, and then sort of further reflection questions perhaps at the end. Is that okay? Yeah. Okay. So, and this is why I can't take reflection questions in the middle. I forget what to pay for. Voluntary information. Okay, so we've got voluntary information here, and this is a bit, to me, which is particularly interesting, because these agents provide this information without actually having to provide it in the first place. So, generally, when we discuss this model, I think it's quite important also that we introduce another external factor, which is that of the audit function, whereby before this information is released to the principal, the agent audits the information. There is the auditor comes in and verifies that the information is true and fair, based on basically roughly the standards. There is a lot of controversy about this audit function and whether it's neutral or not, whether it's independent or not. There is a lot of controversy with the standards themselves, the extent to which the standards are neutral or not, but that's not really what I want to talk about. I'll just highlight that to you just as a matter of awareness, completely separate discussion there. But what I'm going to look at today is basically the provision of this voluntary information by the agents to the principal through one particular mechanism, which is the financial reporting mechanism. And by the financial reporting mechanism, I'm talking about one particular document, which is the annual report. Okay? So that sort of, hopefully that frames a little bit about what I'm going to be talking about in the next couple of slides. Okay, environmental reporting, in a sense, actually is a very, very broad area. And I'm actually just going to pick sort of one particular aspect about this. But because of this breadth, I think I need to sort of still give a bit of context of how this area evolved in general. I'll try and be very brief about history because you can sort of tell a story forever. One major contributor in this area is Professor Rob Gray, who's actually now at the University of St Andrews. And he's basically been the voice of environmental reporting, environmental accounting over the past maybe about 40 years. He started in the late 1970s, and he still is sort of the eminent scholar in this area. And when Professor Gray started off, the area was called social accounting, and his idea, or his trajectory, was that accounting shouldn't stop at just providing financial information. We should have a broader remit. We should include social information. And under that social information is environmental information. Now, in his couple of his recent articles, which now sort of read like a personal memoir of his experiences with social accounting, he reports that when he first started out in the 1970s, or the late 1970s and the early 80s, the idea of providing anything other than financial reporting information was met with either indifference or hostility. People just were going to him and say, why bother with this? That has changed quite a lot over the years. Gray argues that a lot of this has got to do with the changing politics as well. At the end of the 70s, he argued we're moving to the Thatcher era, where there was a slightly different economic situation. Whether you buy his argument or not, I leave that to you, but that's his justification for that. And so in the 1990s was when we started to see this movement gaining some sort of momentum. However, it didn't come out in the way that Gray sort of envisioned this in the 1970s, because he was looking at providing reports on human rights, providing reports on how companies engaged with countries that were particularly controversial. For example, selling arms to particular factions that are in particular conflict. But in the 1990s, what moved out of this was environmental information, so a small subset of that. Gray published a book called Accounting for the Environment around the same time, and what we've started to see is the popularity of the provision of environmental information in financial reports of firms. Now, over the years, what people have noticed is the headlines that sort of precede this, or that serve as the banner. In the early 1990s, we saw this kind of report being termed the Green Report, or it's termed Green Reporting, or it was called environmental reporting. It used to be, at the beginning, a subset of corporate social responsibility reporting, which was another sort of area of voluntary disclosure. And then, towards the mid-1990s, it started to emerge in its own right as environmental reporting, and in the last perhaps 7 to 10 years, it's now coming under a different banner called sustainability reporting. So that's kind of like the phrase or the headline du jour at the moment. It still kind of refers to pretty much the same thing. But the information that's being provided hasn't actually differed as much. It's only sort of using the use of the language has changed over the years, trying to sort of fit within contemporary times, I suppose. My personal reflection on this is, or my personal experience having looked at environmental reports, that I thought that they used to be a lot more focused when they were called environmental reports. Now that they're called sustainability reports, people tend to chuck in everything that they can under that banner. I was teaching this a couple of weeks ago to the MBA students. They were looking at the sustainability report of Babcock International, which is a defence firm. And only 20% of information in that report was actually anything to do with the environment or sustainability. The rest of it was talking about employees and human resource functions, and just sort of lots of narratives about things that weren't quite befitting the banner of environmental reporting. And this has changed if you look at the kind of environmental information that was provided in firms, by firms, in financial reports about 10, 15 years ago. So there is sort of some slight changes in terms of the content as well. Okay, so looking at an area this wide, we do come across quite a lot of complexities. I'm just going to talk about two here, which I think are two of the most important ones. And the first is to do with the lack of a consistent standard. Because financial reporting is governed by accounting standards, and annual reports are governed by what the standards require. Financial statements in annual reports are governed by accounting standards. You'd think that there'd be some guidelines, some accounting guidelines, as to what should go into an environmental report, but not so. What we've got a situation where there are specific accounting standards that deal with environmentally related issues. I'll give you a couple of examples that I've got down here. For example, in the accounting standard that deals with how to account for property, plant and equipment, okay, there is some information in there about how to dispose of hazardous materials. Or the accounting standard that deals with provisions or contingent liabilities, how to make provisions for potential costs. There's something in there about how you would make estimates about environmental costs. And normally that's where you find environmental cost information in the annual report. And then broadly you've got like more general standards, like standards that are related to financial instruments, which may become relevant if the company decides to use some financial instruments to hedge their environmental exposure. And then there are some standards, two, that come to mind. One is IS 41 on agriculture, and the other one is IFRS 6. I'm actually just showing these numbers. That might be completely wrong. I don't know what the numbers exactly are, but no, they are IS 41 and IFRS 6 actually. Talking about agriculture and mining respectively, both of which are to do with industries that actually affect the environment. So these have got some context-specific environmental information. But overall, if you want to prepare a standard environmental report, there is no such guideline to tell you what you should be in that report, what shouldn't be in that report, what kind of information should, what the presentation should look like, in a standardized format that people are used to when they pick up a set of financial statements. Because if you pick up a set of financial statements, you look at that balance sheet, you know that the first thing, it's called a balance sheet, hopefully both sides balance, and then you know what's in it. If you look at the income statement, you can figure out what the profit is. There is no similar structure with regards to this. So, what firms do is they rely on voluntary standards. These are publications provided by bodies such as the GRI, the Global Reporting Initiative, or the body called Accountability, which provides some standards. In the UK, DEFRA, the Department for Farm and Rural Affairs, have some environmental standards. So these are what firms naturally use as benchmarks as to what information they should include in an environmental report. The Association of Certified Chartered Accountants, ACCA, every year, they provide sustainability awards to companies that they think do the best sustainability reports. So firms use the criteria of successful firms as a benchmark. But as far as accounting itself is involved, it's very, very little standardized information, which kind of impacts on the comparability of this information. Because at the end of the day, what you want to do is pick up 2 annual reports and figure out which firm is doing better from an environmental perspective. If you're making an investment decision, you want to figure out which firm has more risk, or is posing more risk to the environment or not. And there is the lack of a consistent standard, okay, is basically making this quite confusing for people, because no two reports are exactly the same between 2 companies. They might be the same though between 2 years within the same company, which is something, you know, there's a boilerplate sort of exercise as well that's going on. So at the moment where we are with this, there is the there is an International Integrated Reporting Council, which is looking at providing such, you know, a standardised format for environmental reporting. They are currently working with the International Federation of Accountants, IFAC, but the main standard setting accounting body, which is the International Accounting Standards Board, has been largely silent with regards to this, except in one respect, which is carbon accounting, which we'll return to a bit later on in the discussion. So that's one complexity, this lack of standards, making it hard for you to compare information, and hard for you to really make any use of, you can make some use of it, I suppose, but hard for you to make any informed decisions based on information in varying formats. The other issue, or the other complexity, is the slow response from financial reporting as a discipline. Now, this is not something that is unique to environmental reporting. It is a problem that is systemic within financial reporting itself. The fact that, for the most part, financial reporting responds to issues in a firefighting kind of way. If there's an issue, we'll put the fire out, but they don't actually go and find somebody who's lit the match who caused the fire, kind of thing. And this slow response, Holland and Fu note that environmental law has moved so fast. And are there anybody here from law? Okay, because law is, my sister's a lawyer, law really isn't the one thing that you'd say is fast moving, you know, it needs to go to Parliament, it needs to be tabled, it's a long due process, and yet it's faster than financial reporting is moving with regards to this. Environmental law has got all these regulations in place, and yet financial reporting still hasn't got the mechanisms to appropriately reflect what we need as a result of the law. And so this slow response from financial reporting, I think, also in a way impacts the problem that we've got here with the lack of a standard, because they're just so slow at trying to adapt to what's going on. The issue of providing a standard kind of elongates and goes on for quite a bit. So, what we are faced in corporate environmental reporting at the moment is a situation where firms provide endless narratives of information with a couple of tables, with a couple of charts, here and there, telling us what's going on, what's being done, what they've done over the years and so on, without actually really providing a standardised format. If you pick up any kind of environmental report or sustainability report, a lot of it you will find is narrative. So, these are the two sort of constraints, as it were, that financial reporting and environmental reporting kind of currently operate in. Okay, so what is corporate environmental disclosure or corporate environmental reporting? This, to me, I define this as the practice of firms providing information about their environmental activities to an outside audience, to anybody that's interested. The mechanism that is used to do this is the annual report. The annual report is by far and large the most widely distributed means of communication from a listed company to its investors and anybody that's interested, but its stakeholders, to encapsulate that in a word. And as we've discussed, some of these disclosures are mandatory and are required by law. But for me, of course, the interest lies largely in the voluntary, because the voluntary allows us to ask the question, why? Why bother doing this? The answer is quite obvious, really, if the news is good news, right? You always want to share a lot of good news with other people. But by far and large, most of the activities of a firm isn't engaging positively with the environment. Most of the activities of the firm damage the environment, whether directly or indirectly, whether they intend to or not. There is no way that you can produce paper to write on if you don't chop down some trees. Although, of course, you could always plant more trees to make up for that. When it's bad news, then it becomes more interesting, because bad news usually affects share price in a negative way, and therefore there are different pressures and different motives behind why firms want to provide this kind of information. So, just get the next two bits out there. Talking about the whys. Why do firms actually do this? And the late Anthony Hopwood, who is an eminent accounting professor, formerly of the LSE, he posed a really interesting question when he was writing about this a couple of years ago. And he asked how much of corporate environmental disclosure is actually just the use of disclosure to get other people to shut up. It's providing the information so that people won't ask you anything else. It's kind of a useful tactic to use most of the time. You provide them with information beforehand, and then people just don't ask him any questions afterwards. So if you provide even rudimentary information beforehand, that would satisfy some people more than giving the no information in the beginning. So let's look at some existing research questions that are within this area. Existing questions that are discussed in the literature, and when I say literature, I mean this I mean literature in the positivist and interpretive traditions. I am not too engaged with the critical tradition, although even a lot of the positive and interpretivist work in this area is very critical of what's happening anyway. And really that sort of limits my familiarity with the critical theory perspective. But again, with that caveat in mind, first question that people ask is why? Why do firms disclose this information? Or what are the pressures, okay, that's pushing them to disclose this information? At the same time, people are also looking at theories to explain, or to best explain, why firms do this. Because There is existing debate on what the best theory is. I'll return to that a little bit later. People also tend to ask, what's in it for the firm? Firms are known to be, or firms are not really expected to be altruistic. They won't really do something if they don't get anything out of it. So the question is, what do firms get out of it? How much of this is just impression management? How much of this is just a PR exercise? And in the lack or in the absence of any clear standard, how do we know that this is not just a PR exercise? How do we sort of separate, what's good and what's bad in this? So this has also sort of resulted in the emergence of assurance services, a means for the firm to try and convince people what they're doing is actually quite useful. Again, we'll return to that in a little bit later. And so what else have I got here? And of course, if we're discussing things in a corporate setting, we also must think about investors. Do investors care? Should we care about investors? Should we care about whether investors care in the first place? My short answer to this is that we should really care about investors, because the way corporate financial reporting works today is that everything is seen through the lens of the investor. The investor is basically our gateway to information. So if we can get investors to care about something, be it environmental information, be it human rights abuses, be it the amount of money that is being paid to top executives, if we can get them to care, then they can actually exert pressure on the firm. I mean, in a utopic sense, it would be nice if we operated a more stakeholder-friendly, where we get to have a say despite the absence of a financial stake. But at the moment, that's not the way the world works. So we sort of need to have a look at investors, regardless of whether we stand, where we stand on the shareholder primacy debate. So really, in this respect, even though we aren't investors, we need to take some consideration as to what investors do, because they are the way in which they are the party with which we need to engage in order for us to be able to engage in with corporations. Okay, so I mean, these are sort of common themes that we find, and in the next couple of slides, I'll talk about what we already know about environmental reporting and what we don't know. I will end with a brief research agenda. It's a personal research agenda, what I think is particularly interesting in looking into this, because my intention is to start off some more interdisciplinary collaborative work in this. And please note that in order to limit space, I haven't actually put down any references, specific references to the cases that I'm going to talk about later. If you're interested in any particular area, I can give you the list of references. My EndNote has got about 310 references on this at the moment, and we'll just have endless slides of reading of names of people and numbers at the end if we go on to that level of detail. So I'm going to talk about the broad areas. If you're interested in the broad area, do get in touch and I can give you some specific references about the papers that have looked at these areas. Okay. So moving on to the first item, what do we know? Well, we know quite a lot about what firms choose to tell us. There is a lot of descriptive evidence, descriptive papers that tell us what that reports on what firms tell us. This may be slightly obvious, to most of you, but the thing is that in the absence of a standard, and because firms hold a lot of discretion about what information they want to release into the wild, as it were, you see a lot of variation in what firms provide. There is an abundance of descriptive analysis out there that tell you basically that are just simple analyses of what firms like to, or firms prefer to say, or to disclose. A paper that I can think of, one paper that I can think of off the top of my head right at the moment is this paper by Jose and Lee in 2007, Journal of Business Ethics, which basically tried to synthesize the different kinds of information that firms try to provide of the largest 200 firms over a number of years. What we know is that firms provide qualitative rather than quantitative information, largely qualitative, only begrudgingly quantitative. Okay, Jose and Lee sort of have a nice little table in their paper that picked this up, showing that about 80% of firms talk about their philosophy and their environmental strategy, but only 20% actually provide any kind of information as to how they've attained targets that they've set for themselves in an environmental sense. So firms also tend to provide more information about good things that they do rather than negative information. Deegan and Gordon found this in 1996, and it's been repeated, and it's been consistently found over a number of years in a number of studies as well. We also know that firms tend to provide, we also know the type of firms that tend to provide more information. There is evidence that the extent of voluntary disclosure of environmental information vary according to the size of the firm, the industry that the firm is involved in, the extent to which the firm is widely known. So if the firm, it's a political sensitivity story almost. If the firm thinks that they are popular or they have a particular brand in the market, they tend to be more likely to provide this information. Also, news exposure of a firm's environmental activities, the likelihood of the media picking this up encourages them to provide more information. And also the probability of being involved in a future incident. So if they are high-risk firms with high probability of being involved in a particular environmental crisis, they will provide more information. And also, lastly, the extent of environmental lobby groups' concerns. Firms that are subject to a lot more environmental lobbying tend to provide a lot more voluntary information. I mean, these are they're not counterintuitive, they're pretty straightforward, and there is empirical evidence to back this up. What is less clear is how environmental disclosure or environmental reporting has a relationship with various kinds of performance. We can differentiate studies at looking at this into three. First is the relationship between environmental performance and environmental disclosure, which is really talking about, do firms actually disclose what they actually do? Okay, so there is that link, the studies that look at that. And then secondly, the relationship between environmental performance and financial performance. So if firms actually perform well environmentally, does that lead to financial or better financial performance? So is there an econometric link between those two? Slightly spurious, but still studied in the literature, is the link between environmental disclosure and performance, financial performance, sorry. So if firms provide more environmental disclosure, does this actually have any impact on their financial performance? So we know a little bit about that in terms of in terms of what they do. The problem is that a lot of the studies that look at this performance disclosure kind of relationship lies in the positivist tradition, where people put everything in a regression machine, crank it down, and you get statistics at the end of it, which is something I like to do, I must admit. But the problem is with that is you are so dependent on how you specify the model, and you are so dependent on the econometrics of that particular model. So if you misspecify a variable, or if you misspecify the model, or if you don't put in the appropriate controls, everything kind of falls apart. And a lot of the mixed evidence in this area, I think, is largely to do with the need for continued improvement in the specification of the models that look at this. We also know a little bit about some of the motives behind voluntary disclosure. And again, this comes up to the theories that we are discussing a little bit later on. We know a little bit about why firms do this. One of the reasons is to do with just political management of the situation, trying to manage the politics of providing this information. We know a little bit about what theories can explain the motives, okay, but not too much. There are a series of competing theories that look at this, which I'll list to you in the next slide. But I'm going to sort of reserve that discussion for the bit where we talk about what we don't quite know, or we don't know yet about this, because there's quite a lot more that we don't know about theories than what we already do know about the theories. We know a little bit about institutional factors and international differences. There is evidence that shows that different regulation or regulatory environments affect voluntary disclosure. So even though voluntary disclosure isn't subject to regulation, the aura of regulation, or the environment of regulation in a particular country could shape people's attitudes towards providing disclosures. And there's evidence of these differences between both the US and the UK, and also between North America and Europe. North American firms are more focused on shareholders than stakeholders, and therefore their disclosures tend to reflect that, the extent of voluntary disclosure, and also what they provide tend to reflect that. European firms are more stakeholder oriented, and again, there seems to be some discussion on that as well. Okay, so lastly, I think on this slide, what I'd like to talk about, or what we already know a little bit about, are investors. I'll put that on the slide. We know a little bit about investors, and with regards to the positivist kind of work, there is a body of literature in accounting called the value relevance literature, which really looks at how useful this information is, how useful environmental information is. The assumption is that if environmental information is useful, it will have an impact on future earnings. That body of evidence is quite sketchy, but I'm happy to report that when two researchers actually went out and asked investors, from a varied background, there is a lot of evidence to suggest that investors do want this information. It does make a difference in decisions that they make, and this has changed from, let's say, 10, 15 years ago to evidence in the Solomon and Solomon paper, which was provided in about 2005. So, moving on to what we don't know, what firms really do. And I've put a note there, Sarah's work, and I'll talk a little bit about that in a minute. But because there is a lot of information asymmetry, there is a lot of stuff that firms do know what they do that they don't tell us. So in essence, we don't really know what firms get up to. Sarah is a former EBS PhD student, now a member of our staff, who actually went to look at this, corporate social responsibility in general, but also including environmental information. And what Sarah did was she went to study the activities of mining firms in an African country. So she went to the headquarters. There was the whole corporate spiel telling them this, and that, and that. And then what she did after that, which the company didn't know about, was she actually went out to go to these sites where they said they were doing these things. And she found a lot of environmental degradation, a lot of toxic waste being put in the water, and so on and so forth, despite the fact that their annual reports can try to paint a slightly different picture. So, not saying that all companies are this corrupt. I'm not saying that this is a standard modus operandi, but it does tell us a little bit about the decoupling between what firms say they do and what they actually do. We are also still a lot unclear on theories. Which theories best explain environmental disclosure? Some of the theories that people have used include impression management theories, legitimacy theory, institutional theory, stakeholder theory. Clarkson and a series of papers by Clarkson and also Charles Cho, they've looked at how to look at which theory is actually more dominant. And the interesting thing was one paper found voluntary disclosure the more eminent theory, the other paper found legitimacy more important. So still quite a little bit that we need to know, or we don't quite know yet about environmental disclosure. Last but not least, which is sort of this is really quite interesting to me, even though it's not really involuntary disclosure, is that how do we fit environmental reporting into the existing financial reporting model? So this is a slightly bit more technical accounting issue. Even for firms that are already have environmental costs within the financial reports. Okay, I'll give you an illustration of how misleading this information can be. In 2009, okay, the year before the Deepwater Horizon disaster, BP estimated or provided a provision of $1.7 billion US, okay, for potential cleanup costs that they may incur should something happen. The year after, just the year before in the financial reports, the cost of cleanup is currently, as of 31st July 2012, which is the last I looked at it, is 38 billion. So that's 38 times what they actually allowed a provision for. And accounting, in that respect, kind of failed in trying to engage with the enormity of this particular environmental impact. Yeah, how do we fit this within the existing model? There's also issues of having these as line items, but I won't go on too long for that because it's too technical in an accounting sense. So moving on forward, what do we want to know? We want to know more about what? I think there is, of course, something to do. We need to do in looking at the depth of what we already know and exploiting existing gaps. But we need to have a lot more information on international evidence. Existing international evidence focuses on the US and UK, North America and Europe. We don't know too much about how the situation is in Africa and how the situation is in Asia. And really sort of what's particularly interesting here is because a lot of the green resources of the world, if you allow me to use that phrase, is no longer in North America or no longer in Europe. And yet there's little information that we know in a comparative sense and even in an absolute sense about how environmental reports, what environmental information, what environmental performance is in these countries. There are some method issues. These are econometric issues. How do we better evaluate this relationship between, how do we tweak the model? There is also a need to improve, I believe, disclosure quality metrics because disclosure, at the moment, existing work tend to use disclosure quantity as a proxy to quality. So, things like word counts or page count. How many times do you say the word environment on a particular page, sort of thing. Need to sort of move a little bit beyond that, and yet try to sort of measuring disclosure quality. By the way, is probably the hardest thing to defend to a reviewer. They kind of don't want to believe what you say about how you measure disclosure quality because it's so subjective. And from a cross-disciplinary perspective, I think we know a little bit about environmental disclosure narrative, but there is a lot of space in looking at this from a sociolingual or a lingualistic perspective in what is being actually said about environmental performance in the narratives. If you've ever picked up any kind of environmental information, environmental report, you will find that a lot of the information is narrative, and there is an obfuscation story. How much of this is just trying to hide information in the mass of words that's there? And accounting has got some methods of unpacking this, but I think to really properly look at this, we need to share our knowledge with linguists. Okay, last slide. Very, very briefly, two things that I didn't touch upon in my presentation, but I think are starting to emerge in the literature, which I believe warrants some sort of acknowledgement. First of all, the area of carbon trading, accounting for carbon trading, and to look at how this fits in with existing financial reporting framework. Until very recently, the International Accounting Standards Board actually looked at accounting for carbon trading as an exposure draft and as a standard to cater for this. But for some reason they've stopped the project at the moment. And there is academic work that's looking at this, but I'm a bit wary about this because carbon trading is something that's easily quantifiable. We may emerge with a standard that deals with something that's easily quantifiable, like carbon trading, and let's not forgetting that there are a lot of other things that we need to account for, we need to be accountable for, which is not as easily quantifiable as carbon rights, which runs the risk of being swept under the carpet because we don't actually fit this into the financial reporting framework properly. So the other thing that has emerged is assurance services, auditors. What we've got here, this is really talking about audit services provided by audit firms or specialists or Big Four, who actually try to provide. The whole point of providing an audit service is to assure the users that things are true and fair. A lot of this is statutory; it's required. But we see that even though this is something that is voluntary, a lot of firms are now picking up and paying for assurance services in this in order to certify the validity of their financial of their environmental report. Problem with that is that first of all, we don't have a standard, so what are we actually basing this on? And second of all, if it's not voluntary, then what is this really telling us? What are we really being assured of here? Are we actually being assured of good environmental performance of the firm? Or are we just really being assured that which firms have extra money to throw around so that they can buy these kind of services? So again, two slightly emerging areas in the literature, which I didn't cover in that much depth, but